Hello there everyone, today's video is all about income tax planning, specifically pension contributions, making individual pension contributions. Now, what prompted me to make this video today? Well, it's the 31st of July, and as many people will know, that is a big deal in the self-assessment calendar. It's normally the day that you pay your second payment on account for the tax year. So, the tax year ended 5th of April 2021, which we are now past, ended 3.5 months ago. The tax due for that year is broadly split in two, and half of it was due in January 2021 and the other half is due right now. But of course, those figures are based on the previous year until we have certainty on what is in the tax return for the 2021 tax year, which could be many months from now. So then you also potentially make a third payment, a catch-up payment, in January 2022. But anyway, 31st of July, always a big deal in the self-assessment world. So, as a form of income tax planning, pension contributions are one of the best that you can do to save on your income tax bill. And also, which is quite topical, is the rumours and the rumour mill and the press speculation doing the rounds is that the Chancellor and the government will look to axe higher rate pensions tax relief to help pay for the COVID pandemic bill. Currently, the tax relief afforded to pension contributions amounts to several tens of billions. So, and most of that tax relief is, the cost of that is for higher rate taxpayers because they're the ones that are saving the most in tax. So politically, it would go down well, the fact that they are stopping a tax break that essentially is more favoured towards the rich, as they would dress it up on their marketing propaganda spiel. But anyway, regardless of that, pensions tax relief, it's a great thing. It really is a terrific way to save on your income tax bill, and you should put as much away into a pension as you can, because not only do you get the tax relief on the way in, you get tax-free growth as well. And if it's there for many decades, you really can build up a nice nest egg in a pension. So let's just explore the mechanics of an individual pension contribution. So assuming you're putting a £10,000 contribution into your personal pension. Now let's assume that's a gross contribution. So what do we mean by that is? What we mean by that is that you physically write a cheque for £8,000 and it goes into your pension, and the government then top it up. They will write a cheque to your pension provider for £2,000 to take that £8,000 up to £10,000. So you are getting 20% tax relief. In effect, you're getting a cheque from the government going into your pension fund. That's when they say that you're getting 20% relief from the government, is the extra amount that they are contributing into your pension. So you put in 8,000, the government puts in 2,000, you've got £10,000. Hence the 20% relief, 2,000 out of the 10. Now, if you're a higher rate taxpayer, this is where it gets even better. And this is what they're thinking about putting the brakes on. If you're a higher rate taxpayer, in addition to the 20% you've got actual top up of your pot by the government, on your tax return, you claim another 20% tax relief. Specifically, what you do, it extends the point at which 40% tax kicks in, so you're paying 20% tax at the basic rate for that much longer based on the value of the pension that you put in. So in effect, it's tax relief in two different areas. 20% on your tax return, 20% top up by the government. That's your 40% tax relief right there. So that gross £10,000 contribution has only really cost you £6,000. Hence, £6,000 is the cost to you, but you've got the benefit of £10,000 in your pension pot, 40% tax relief. You wrote a cheque for £8,000, the government topped it up for £2,000, then you got £2,000 back via your tax. Now, that's the area that all the commentators are suggesting the government will change, whether it's going to be in the autumn, or maybe he'll wait until the budget 2022 in the spring. Who knows? But all bets are on. I mean, we've been talking about this for years, but never has there been more of a time where we think this will happen, because of we've never had COVID reform, when the public finances are in such a mess that it would be quite an easy win, if you will, for the government to raise several tens of billions fairly easily. What will they do? Will they just scrap higher rate relief and say, in my example, you get your 20%, you put in £8,000, government tops it up to 10, that's it, no more shenanigans on your tax return to claim back more? Or will they say, okay, we'll still give you a little bit more relief than 20%, maybe a flat rate, 25% or 30% relief, but not the 40% relief that you get now? Who knows? Now, of course, that 40% relief in my example can be even better than that, and I've done separate videos on this, because if you are a taxpayer earning more than 100 grand, you are technically a 60% taxpayer, because that personal allowance that everyone gets is retracted, and so the tax that you suffer between 100 and 125 grand of earnings is taxed at 60%. Now, when you put a pension contribution in at that level, you in effect get 60% tax relief, not 40%. So it really is a powerful tool from a tax planning point of view for higher rate earners. But like I said, politically, easy to just reverse that when most people aren't benefiting from the higher rate, even though it costs, it saves a lot of money for the higher rate taxpayers. They are in the minority of the electorate. So we'll see what happens. But from a tax planning point of view, my advice from this, the takeaway from this video is get in now before the government change the rules and go from, say, higher rate relief, whether it be 40%, 45%, 60%, and it could drop right the way down to 20, 25%. So if you've got a few quid that you've saved during the pandemic and you want to invest it, put it away, think about getting it in a pension, think about saving thousands of pounds in tax and saving for your future. So it's just a quick overview there on individual pension contributions. If you like this video, do please subscribe right there, and I will see you soon.